Look at a modern assembly line, or walk through a corporate accounting floor. You will likely see two things working side by side: a human being and an automated system. To the economy, they are both producing value, but to the government, they are treated completely differently. Every hour the human works, the state extracts a heavy penalty. We call it an income and payroll tax. But the automated system, the corporation that purchased it, is rewarded with R&D tax credits and accelerated depreciation. We financially penalize the human, we subsidize the machine, and then we act surprised when human workers are replaced. We are living through a collision of two historic forces. The first is a demographic collapse. In South Korea, the fertility rate has plummeted to 0.7. In Japan and Italy, it is 1.2. By the year 2030, nations like Germany, Italy, Japan, and South Korea will hit an elderly dependency ratio of nearly 50%. That means for every two people of working age, there will be one retiree requiring pensions, healthcare, and infrastructure. The second force is the artificial intelligence and robotics revolution, arriving just in time to replace the workers who were never born. But this creates a fatal mathematical paradox. The modern nation-state is funded almost entirely by taxing human labor. If demographic collapse forces countries to automate just to maintain their current production levels, but their revenue relies on taxing human beings who are no longer working, how does the government avoid bankruptcy? To understand the trap we are in, we have to look at the architecture of the modern welfare state. It was built in the 20th century on a very specific assumption: a pyramid-shaped demographic model. A massive, continuously growing base of young workers whose income and payroll taxes would easily fund the smaller group of retirees at the top. Because human labor was the primary engine of the economy, taxing human labor was the most efficient way to fund the state. But our tax code is not technologically neutral. It has developed a severe asymmetry between capital and labor. If a business owner hires a young worker, the business must pay a portion of that worker's Social Security, healthcare, and payroll taxes. The human is an ongoing tax liability. If that same business owner buys a software algorithm or a robotic arm, the tax code treats this as a capital investment. The business can write off the depreciation. They receive tax credits for innovation. We have inadvertently designed an economic system that treats human beings as a cost to be minimized, and machines as an asset to be incentivized. For decades, we debated whether automation was a choice. Today, the demographic data proves it is a strict mathematical necessity. The working-age population is shrinking too fast to sustain the global economy. In Japan, they are not debating whether robots will steal jobs. They are actively subsidizing medical and service robots just to keep their eldercare systems functioning. The humans simply do not exist in the numbers required. This means the transition to an automated economy is not a malicious corporate plot. It is a desperate survival strategy, but as the human workforce shrinks, the tax base shrinks with it. Governments are caught in a vice. They need the automation to keep gross domestic product from collapsing. But every time a human is replaced by a tax-advantaged machine, the government loses the payroll tax it desperately needs to fund its pension systems. When we step away from the macroeconomic data, we can see the crushing weight of this reality on the individual. Consider a young worker today in Berlin or Seoul or Rome. They are living under a phenomenon economists call the double burden. Because the worker-to-retiree ratio is collapsing, this young worker faces the heaviest tax burden in modern history to fund the pensions of the aging population. Simultaneously, they are trying to save for their own increasingly volatile future in an economy where their labor is competing against subsidized artificial intelligence. They are paying for a 20th century social contract that they themselves will likely never benefit from. We are asking a shrinking generation of young people to outproduce machines, while carrying the entire financial weight of the state on their shoulders. And because human labor is so heavily taxed, businesses are looking for any excuse to avoid hiring them. And what happens because of that? We arrive at a deeply counterintuitive phenomenon known as so-so automation. Normally, a company invests in new technology because it is vastly superior to the old way of doing things. But because our tax system heavily penalizes human labor, a business might replace a human worker with a machine, even if the machine is only marginally effective. If an algorithm can do a job only 85%, as well as a human, the business will still make the switch. Why? Because the tax savings of eliminating a human employee make the downgrade profitable. This is not real innovation. This is tax arbitrage. The second-order effect of our asymmetrical tax code is that we are adopting automation that doesn't actually create a massive surge in national productivity. It merely shifts money away from the state and the worker and transfers it to corporate capital. Human employment drops, government revenue evaporates, and society doesn't even get the benefit of a vastly improved product. When faced with this crisis, the political reflex is obvious. If the robot replaces the human, we must tax the robot. Prominent voices from Bill Gates to the European Parliament have suggested a robot tax to slow down automation and generate funds to retrain displaced workers. It sounds deeply logical and highly moral. But there is another way to look at this. We don't have to guess what a robot tax would do, because South Korea already tried it. South Korea has the highest robot density in the world and the lowest birth rate. In 2018, attempting to protect its workforce, the government implemented a quasi-robot tax by drastically reducing the tax credits for automation investments. The result? Robot installations fell by 28% compared to competitors. Did human employment suddenly surge? It did not. There was no statistically significant increase in jobs. Instead, South Korea suffered a net budget loss. By trying to protect the human worker through a penalty on machines, the government merely slowed down the technological progress required to keep its shrinking economy afloat. If a robot tax stifles innovation and taxing humans yields diminishing returns, the entire system begins to buckle. Look at the trajectory of the United States. Federal debt is projected to reach an astounding 175% of GDP by the year 2056. The technology industry often argues that artificial intelligence will generate so much unprecedented wealth that we can simply grow our way out of this debt. But economic projections tell a much more sobering story. Even in the absolute most optimistic scenario for AI-driven productivity, that U.S. debt projection only drops to 126% of GDP. Artificial intelligence will not save the sovereign balance sheet. When a state can no longer fund itself through income tax, it will hunt for a new physical footprint to tax. If you cannot tax the algorithm, you tax the energy the algorithm consumes. We are already seeing this in Virginia. The state has proposed a direct tax of 1.1 cents per kilowatt hour on data centers, aiming to generate $600 million annually. This is not a tax on labor or a tax on profit. It is a tax on compute. It is the first signal of a desperate systemic shift, the transition from taxing human sweat to taxing machine energy. How does this resolve? We are looking at three distinct scenarios for the coming decades. Scenario A is adaptation. Governments recognize the fiscal illusion and establish technological neutrality in the tax code. They drastically reduce the payroll taxes that penalize hiring humans, and they close the loopholes that allow capital and automated profits to escape untaxed. The marginal tax rate of human sweat and machine output is equalized. Innovation continues, and the aging population is funded through a fair tax on capital. Scenario B is disruption. Driven by political panic over AI, governments implement aggressive, poorly designed robot and compute taxes. Capital simply flees to automation havens, countries with low taxes and high-tech infrastructure. In the countries left behind, innovation stalls. The debt spiral accelerates past 175% of GDP, leading to the collapse of Social Security, extreme austerity, and the fracturing of the social order. Scenario C is transformation. The state abandons the concept of the income tax entirely. Acknowledging that human labor is no longer the primary driver of economic value, governments institute an autonomous value-added tax, or sweeping energy consumption taxes. Revenue is completely decoupled from human employment, fundamentally redefining what it means to be a citizen in a state funded by machines. For a century, our worth to the state was measured by our labor. If you worked hard, you paid your taxes, and the system promised to catch you when you fell. That contract is now broken. The demographic reality requires us to hand the means of production over to automated systems. The machines are not the enemy. They are the only bridge over the demographic abyss. What we now understand is that the crisis of the 21st century is not about artificial intelligence stealing our jobs. It is about a tax system that actively punishes human labor while failing to capture the immense wealth generated by capital. What remains uncertain is whether global agreements, like the OECD's 15% global minimum corporate tax, can actually prevent digital capital from hiding in offshore havens before national budgets collapse. We do not yet know if the bureaucracy of the state can rewrite its own code fast enough to catch up with the code written in Silicon Valley. If a machine does the work of 10 people, quietly sustaining the economy of a shrinking nation, should the wealth it creates belong solely to the person who owns the machine, or to the society that provided the stability for it to operate? Key revelation. The tax code actively punishes hiring human beings through payroll taxes while subsidizing the purchase of machines through capital depreciation and R&D credits, leading companies to automate just to avoid taxes rather than to achieve actual productivity gains. Future scenarios. Scenario A. Adaptation. Tax neutrality is achieved. The penalty on human labor is lifted and capital tax loopholes are closed. Innovation thrives and the state is funded. Scenario B. Disruption. Governments panic and implement heavy robot taxes. Capital flees to automation havens, innovation stalls, and national debts spiral past 175% of GDP, collapsing the welfare state. Scenario C. Transformation. The state completely decouples revenue from labor, pivoting to energy footprint taxes like Virginia's kilowatt-hour tax and autonomous value-added taxes commerant dilemmas. If a company replaces you with an AI not because the AI is smarter, but simply because the AI doesn't require the company to pay payroll taxes, who is really stealing your job, the technology or the tax code? Would you accept a future where you pay zero income tax, but the government tracks and taxes every kilowatt of computing power you or your company uses? The young generation is carrying the heaviest tax burden in history to fund a shrinking population of retirees. If we shift the tax burden onto machines and capital, does the state owe its loyalty to the citizens or to the corporations funding it?